Professionals, business leaders, and participants joining us from across the country. Friends, it is my pleasure that I'm welcoming all of you to 161 webinar of corporate professional. So our journey has started in 2020. Until then, every Friday 4 o'clock to 6 o'clock, we are continuously organizing webinar without any fail, whether our mood is there or not, but webinar will be there. So friends, this time we have selected a very interesting topic, buyback of shares, legal, tax, and strategic perspective. Now, when we talk about the buyback, then we can think of so many issues. No doubt legal taxation issues are primary, but what are the strategic issue? Why we want to bring out buyback, and what is the logic behind this? So in the evolving regulatory and tax landscape, buyback has emerged as a very critical tool for capital restructuring, value distribution, and strategic decision. But recent shift in taxation, particularly the move from dividend-based taxation to capital gain treatment, buyback transaction now require a more nuanced and evaluation from legal, tax, and commercial standpoint, because that advantage of tax or tax arbitrage is now nowhere. So whenever you are bringing out buyback, then it's not a tax issue, but it's some strategical issue. So today's webinar, we are aiming that we will discuss about comprehensive understanding of buyback framework under the company's law, SEBI law, because both laws are applicable, and the latest tax regime which is there. It also explored the strategic consideration for promoter companies in deciding whether buyback is the optimal route, or as compared to other alternative like dividend and capital restructuring. Though practical insight, case-based study and discussion and compliance guidelines we will discuss, and this session is well equipped with the professional, those who are sitting on the best company in India, and they are not bringing out the buyback just for the sake of, with some logic, strategy, and some benefit to the shareholders. So today in our webinar, we'll discuss legal framework of buyback, taxation of buyback, post-budget 2026 will be the focus, strategic perspective, practical challenge and common pitfalls, and case study and practical insight. And then we will have a question answer session relating to buyback. For this today's program, we have invited a very excellent panel, and I welcome all my panelists. First, I welcome Manikanta, is a company secretary and compliance officer of Infosys. With over 2 decades of experience, he observed corporate governance and secretarial function for the Infosys, one of the best governed company in India. And he is active member in FICCI and CII committee, and he has worked in so many areas related to governance, related to things, and spreading the governance aspects of Infosys. And whenever I talk money, I always find very important thing that he is not talking about the law. He's not talking about this. The governance is also on the prima facie discussion point also. I welcome Mani for this this program.
Thank you, Paul.
Yeah. Then we have R.K. Agrawal. Dr. R.K. Agrawal is a senior chartered accountant, strategic and dispute resolution expert, and over 3 decades of professional experience. He specializes in income tax, litigation, search and seizure, tax planning, and strategic business advisory for corporate and high net worth client. He is managing partner of Rakesh Raj and Associate, prolific writer, author, speaker, and he has written so many books on various tax aspects. He is a key committee member of ICSI. He was also chairman of Company Secretary Institute Northern India in 2003. I welcome R.K. Agrawal ji. He is just joining. He is traveling, so he will join shortly. I welcome Sandeep. He's a Chief Compliance Officer of Insecticide Limited with over 10 years of experience in corporate governance, ESG strategy, risk management and regulatory compliances. He specializes in SEBI, RBI, and corporate law compliances, along with fundraising, litigation, and high-stake negotiation. I welcome Sandeep for this. You have worked with corporate professionals, so it is our pleasure to welcome you uh, in a different way also, that our person is going and reaching a big heights. That's a um, uh, I think it's good for everybody, especially corporate professional, that our trainees and employees are going. So I welcome Sandeep for this program. Then we have our another speaker, Vijay Shankar. He's a senior general manager, secretarial company secretary in Matrimony Company Limited. So everybody's marriage is very important, and Vijay's company is doing that. So uh, Vijay has 18 years of experience in corporate secretarial function, regulatory compliances. He has extensive expertise in public issue, corporate governance, and listed companies, and he has worked in various companies. I welcome Vijay for this program, and your experience which you have done in your company will be definitely helpful to us. Then we have Ms. Anjali Agarwal, Partner Head, Capital Market, Corporate Governance. I welcome Anjali. And then Manoj Kumar, Partner Head, M&A and Investment Banking, Corporate Professional. I welcome Manoj. Manoj will give a strategic point, and Anjali will tell why buyback, because she handles that department. Friends, before starting this, buyback of shares is no longer just a capital management, and it's a insertion of law, taxation, and strategic decision. Shivam, can you just give the slide? So I have identified certain things, that how the buyback is uh, creating a value creation or capital allocation signal. That is a theme which I want to say. So buyback do not inherently create value. They reveal it via disciplined capital allocation is taking place. So buyback is strongest non-verbal signal a management team can transmit. They communicate internal conviction, perceived undervaluation, and strict capital discipline in a single transaction. Because this is the opinion in my this is presentation is from my side. So these are all my thoughts. Now the capital routing board, why companies deploy buyback. So sometime undervaluation signal they are getting. So that's why trigger market sentiment or re-rating, that when they will buy back, the market will re-rate the company. Dividend alternative, that was also one-time capital return without recurring commitment. That was also thinking, but now it has created a tax hurdle. Then financial ratio engineering. Some of the people think mechanically boost EPS or return on capital and ROC. Then promoters consolidation is also taking place in so many cases, and they are thinking on this. So defense, and sometime a company is a host against the hostile takeover. They follow this principle. Then tax efficiency utilization historical, but now this is not there. So people are following this. Next. Now, the most important thing, the maths of consolidation, how less become more. So financial optics. Now people think that if I do this, my EPS will increase. So optics versus real growth is totally different. We should understand, unless you don't have the business, the EPS cannot increase by just doing this gimmick. It will come back again after some time. Strategic control, no doubt. Promoter is holding 40%, but fresh, sometime they buy back this, the promoter holding increase, because promoter is not participating, other people are doing, so they are going out, so promoters stake can go up. And Manoj, we will take your input also on this, that when this type of thing is happening, how the takeover code, if more than 5%, what will happen? Next is the ripple effect. Who wins when capital returns? Company, efficient capital allocation, avoid long-term dividend trap, support stock price in weak market. That is the one part for the company. Promoter, they still ownership increase. Then strategic control consolidation, hostile acquisition defense. That is for the promoter side. Investor is always premium exit opportunity they get by a tender route, and value unlocking by undervalued stock. So that is another aspect. market, how the market view the buyback. So they because improve price discovery, signal governance quality, because they think that management has sufficient cash, they are earning money, and that's why they are returning. So that is another aspect. Filter serious versus weak management. That is also one indication, because sometimes when promoter buys shares, then confidence comes. When company buys shares, that is also a signal of uh, some seriousness of the management. Next. Now, always we have a confusion that people are doing buyback, and I have one analysis that a company having a market value of 17 rupees, 20 rupees, their market capitalization is low, they have brought out the buyback. So I was just surprising a company of which is 17, 20, 30, 40 rupees, 60 rupees. What is the purpose of their bringing out? Is their market capitalization was more? No, answer is no, but they are bringing out. So we have identified two types of company. One is the value creator and one is value illustration. Like they create illusion. So intent is those who value create, they discipline capital return, because their policy, their framework, their logic will be very clear. But here they supporting a falling market, a stock market, that is their main aim. You will get this here also for value creator company also, but that is not their main source, main intent. Here the main intent is they want to support the falling stock. Financial reality, value creator company, they have excess cash flow and high cash flow continuously going on. Here they think by doing buyback, artificial EPS will go up and we'll get better result, but answer is no for long term. Promoter action, in good company, genuine conviction is there. Here, the cashing out disguised as a shareholder's benefit. So their intention is totally different. So the verdict of this, they want to capital reallocation from this to its shareholders' pocket, and they want to ultimately they create a value destruction. And I have analysis also. In the last time, there are so many companies has come out with the buyback. At present, majority companies going in a negative, but that is a different issue because market is bad. But I compare the buyback price and their present price after the buyback. Also, the 60% company which has come out for the buyback last time, they are in negative. So market has not given any impacts. So buyback is not value creation. It's a capital reallocation from one pocket, but the intent defines the outcome, that why you want to do this. Next. The magic formula underlying growth for capital discipline. Apple, massive EPS growth and wealth creation globally, and they are doing buyback continuously. TCS is also sustained premium valuation. Infosys also, Wipro also. So the mature company with limited reinvestment opportunity are shifting from aggressive expansion to capital return discipline. Buyback alone is equal to success. Business growth plus buyback is to magic. So this is a combination of things. If you see all these four companies which are doing continuously buyback, you will find that they have a disciplined system, they have a mature cash flow, they have a mature management, and doing something with some good intent, not just for the sake of the price things. Next. Then evolution from tax arbitrage to strategic impact, that we will discuss in detail. But my point is, in the past, this is favored over dividend because people thinking dividend is costly, so pay the buyback. Present is different, and future that will be different. So India is moving from tax-driven buyback to strategic-driven buyback. The next phase will definite intelligent capital allocation from opportunistic management. That is also there, because now the promoters buyback, they have imposed lots of heavy taxation. So earlier people were doing this, so they have stopped this so that we will understand from our tax experts and Manoj that why companies had done this. Next. Then a regulatory and disclosure blueprint for the future. Now these are my some suggestions, because I think market trust and governance is very important for buyback. First is intent disclosure. Today we are doing buyback, but we are not disclosing intent. And I have seen this, that USA and UK market, they are giving the UK market giving purpose and authority that why they are bringing out IPO, this their buyback. In India, you are bringing buyback, you are following law, that's all. But we must show the intent that should be the disclosure in future. Capital allocation policy should also be very, very clear that you have a surplus money and you want to invest this. That is also required. Performance tracking, that after the buyback, whether your EPS is increased, whether you have faced something better has taken place, that performance tracking should be there and it should be noted separately. Frequency limit, because some companies are doing with the policy, some company are doing just rampantly. So the frequency limit of those company, like we have a dividend policy, same time buyback policy should also be the part of this. Differential taxation, that is government is doing, but little bit harsh, it should be rationalized. Promoter transparency should be there, that whether promoter why they want to do this, and then ESG integration, that is another aspect which is everywhere is going on. So mandating long-term framework, penalizing opportunistic uses and rewarding genuine capital discipline, that should be the future and that should be the motive. So we can avoid and we can make it more governed system. And the last, next, the buyback does not create value. They reveal management thinking. The real question is not whether a company is buying back shares, but whether it deserves. That is the questions which we have to just understand. So friends, these are my some thoughts and some issues which I wanted to discuss with all of you: intent versus outcome, strategic impact, and practical execution. Now, with all these things, let's understand what is buyback, how it is taking place, and what is the present law. And the SEBI has come out with the concept paper also for introducing the, because open market they have done away. Now they want to introduce again and they want to understand. So Mohini, Anjali, over to you for giving this, and then we will ask other speakers to speak on this.
Good evening, everyone.
Good evening.
Yeah, thank you so much, sir, for giving the detailed presentation. I'm surprised आपने बनाई कब, but it was a very good one, entailing everything which is there pertaining to the buybacks of shares in the Indian listed space. As before starting my presentation, sir, I would really want to congratulate each one of us. It's our 6th anniversary of webinars. We started our webinar journey in the year April 2020, and now we are in April 26, and we are having our 261st webinar today. So a huge round of applause to the entire team at Corporate Professionals who work thoroughly and the research that we people do for bringing out the topics. And a huge...
Anjali, we are having next program on 10th. We are having a 6th anniversary program separate.
Okay, it's then. Okay, I thought 28th to 24th match kar raha tha. Anyways, and a gratitude to the speakers who have been a part of us throughout this incredible journey. Thank you so much, everyone. Now, when we talk about the buyback of shares, we all understand what a buyback is, what would be the impact on the ratios when a company does a buyback. A lot of material is available on the Google, or now the GPT is there. Everything is available thereon. But the moot question that arises is what makes a company think that, yes, I have to go ahead with a buyback, whether it's the market conditions or the tax regime or the my shareholding structure. It's a complex mix matrix and mix of everything. So that is what we have tried to cover in our presentation as well. We are not wanting to cover the law, because buyback regulations per se are a very well drafted regulations. Nothing much is required to be given therein, but the basic purpose is the questions that we receive from various promoters and CFOs and compliance officers when they want to undertake a corporate action of returning the value to the shareholders. I would not be going much into the meaning of a buyback. It's clear repurchase of a shares by the company, thereby reducing the number of shares in the market. Now the question, if we look at these trends, these are the trends which have been prevalent in the market during last 2 years. Uh, During last 2 years, we have seen a significant downfall in the number of buybacks which have come, while the number of issue size, if we talk about, has gone 3 times. The numbers have gone by half, gone down by half, and the significant increase, 3 times increase in the amount of the buybacks. But what's the basic reason? The declining trend in the number of shares, number of buybacks is again a big concern. We can understand because the market prices have gone down, gone up, and accordingly the issue sizes have gone up. So the issue size have gone up is understandable, but the declining number of buybacks, there were majorly two reasons which can be attributed to it especially during 24, 25 and 25, 26. One is the most important reason is the change in the tax regime. Earlier, it used to be taxed in a different manner. Now, for last 2 years, then there came a change that the tax would be as per the dividend model. But now, thankfully, again, with effect from 2026, April 2026, the model has been changed from the capital gain model. So as a result of which, only the gain part of the on the buyback would be taxable in the hands of the shareholders. And simultaneously, SEBI had done away with the open market buyback with effect from 1st April 2025. Now it is proposed to be reintroduced. SEBI has circulated a discussion paper uh, pursuant to which it proposes to reintroduce the open market buyback. So we can assume that the number of buybacks and the issue size of buybacks would see a traction in the coming years. And in fact, as we talk, already 6 companies have informed the exchanges of their decision to buy back, even only in these 24 days of the current financial year. Few of the companies which came out with the buybacks, Infosys, we have Mr. Manikandan with us, GHCL, Bajaj, CSIS. We also have Matrimony is not there in it. We have Mr. Sankar with us. Now, again, as I discussed initially, why a buyback? Or again, why there has been a decline in the buybacks? ऐसा क्या हो गया कि आज की डेट में हम सोचे कि हम बायबैक करें? What has changed over these few days? So why a buyback becomes important? Present scenario, we see that the most of the shares are undervalued right now. We have seen shares whose market prices were in the range of 1,000 rupee. Now they are hovering around 400, 500. A severe undervaluation, while the promoters know that the intrinsic worth of their share is much higher. Likewise, the volatility in the market, 360-degree up and down daily basis where we can see. There are certain news that there is a bearish trend in the market. Amendment in the Income Tax Act, as I mentioned. The company has surplus cash with limited reinvestment opportunities, and post financial, now that the companies are in the process of announcing their results, the annual results, now is the best time to come out with this announcement. These are some of the thoughts which a promoter or a CFO or a CEO generally has in his mind, how to return value. Falling market price is a big concern for all the promoters, all the KMPs of any company. Market volatility, as I said, 360-degree upheaval every day on a daily basis, it is happening. Taxation issues play a very important role. Then cash conservation. Should I actually be distributing the cash or I should conserve the cash? अगर मैं promoter हूँ तो शायद मैं ये सोचूंगी कि is it the right time to distribute the cash that I have, or should I be retaining it in my business for my business growth? Then if I decide of returning the value, ठीक है मुझे, I have to return the value, but then there are various modes available. As Pawan sir also said, capital reduction is there, dividend is there, buyback is there, bonus issue is there, which route to follow? Then benefit that the company will derive post a buyback, because here we are talking about the buyback. So here the main concern is the buyback only. So benefit I'll be getting, the company will be getting post a buyback. Likewise, do I as a promoter, somewhere or the other वो thought भी रहता है कि do I as a promoter get to benefit in any way from a buyback which I declare for other public shareholders? So the most important decision or the question which remains, should I actually be distributing the cash or should I retain the cash with me? We have tried to do a comparison of retention versus distribution. There cannot be any straightforward black and white answer to this question. It is a combination of various factors which through which a promoter or we as merchant bankers help him to take a decision. The financial health of the company. If the company has ample cash, so then only one should think about a buyback. Likewise, evaluation of investment opportunities. I know I can buy a land which will add much bigger value to me and to the other stakeholders. In that scenario, maybe I'll advise him that go in for that asset acquisition. Do not, at present, do not go ahead with a buyback. Then market conditions, present market conditions are such wherein buyback actually becomes one of the most decisive, most important value return aspect. Then shareholders ask expectations. What do shareholders want from me? Do shareholders want me to declare a bonus? They are okay with the price adjustment that would happen, but do they want me to declare a dividend or buyback? All these factors again play an important role. Tax implications have to be thought of. Cost of capital has again to be looked into. What is the corporate strategy? Like, for example, there are many IT companies which declare bonuses on yearly basis. So that is my corporate strategy. Abhi Pawan sir ne ek word use kiya, buyback policy. That also can be a good decision, good regulatory thing, that okay, I come out, I have a buyback policy in my company wherein I have decided that okay, itna percent of my capital every year I'll be coming out with buybacks. Then risk consideration. As I said, there are various modes of returning value to the shareholders. Buyback, dividend, and bonus remain the major aspects when we talk about the value return. They are all independent corporate actions. We cannot compare one with other. Many of the companies do all of them together. Bonus is a separate thing, but buyback and dividend is a very common corporate action which goes hand in hand as well. Sometimes people say ki, can I come out with a buyback instead of dividend or vice versa? Answer is, it again depends upon the matrix wherein you are playing, you're working. So just a brief comparison of what a bonus, dividend, or buyback is. Bonus is capitalization of reserves. Dividend and buyback are distribution of funds, distribution out of my reserves. In case of a bonus issue, my capital increases, but there is no impact on the net worth of the company. Dividend, there is no change in capital. Buyback may, of course, the capital reduces. In a bonus issue, there is no outflow of money. Cash outflow is not there. Dividend and buyback, yes, it is there. Bonus issue, taxation, it will be taxable as a long-term or short-term whenever the shareholder sells those bonus shares. Dividend as per my slab rate in which I am falling. And buyback, now it is taxable as long-term or short-term in the hands of the public shareholders. Now, when we talk about non-traceable shareholders, in the new age companies, this concept is not there. This problem is not there, but any of the companies which came out with IPOs, say 10 years back, 15 years back, वहाँ अभी भी legacy है, जहाँ कुछ non-traceable shareholders या physical shareholders exist करते हैं. So उन case में bonus goes into abeyance and ultimately into IPF account. The unclaimed dividend amounts also go into the IPF accounts. And buyback, there is no impact on altogether because only the people who are traceable will be able to tender their shares. Market price adjustment, there is a market price adjustment in case of a bonus issue as per the bonus ratio. As per the dividend value, in case of a dividend as well, there is an adjustment, but in case of a buyback, there is no adjustment at all. So when we talk about dividend and buyback, IPF thing is one of the important aspects, because dividend is declared on all the shares, whether traceable, non-traceable, claimable, non-claimable. So that is one impact which, wherein I as a promoter or I as a compliance officer should see कि अगर मेरा बहुत बड़ा chunk comprises of physical shareholders and who will not be traceable, I should not be coming out with dividend, because ultimately that money would be going into the IPF account, which is non-usable by anybody. So in that scenario, a buyback is a better situation, wherein actually whatever money I am allocating would be going to the ultimate shareholder. Although I've covered all these points, both comparison of buyback and dividend, both are independent corporate actions, no comparison at all. And buybacks may be more tax efficient under the present regime. Buybacks may be more tax efficient as compared to dividends. Dividends are procedurally simpler. Yes, that is one thing which कंपनीज एट टाइम्स वांट कि डिविडेंड तो बहुत सिंपल है करने में, कुछ करना नहीं, मर्चेंट बैंकर नहीं अपॉइंट करना, फाइल नहीं कर, फीस नहीं पे करनी. Yes, that is there, but the value return aspect is big higher in case of a buyback. Unclaimed dividend accounts are transferred to IPF. I've already told that. When we talk about dual approach of shareholder distribution, that is dividend as well as buyback, gives a double engine benefit to the company. Double financial strength goes to the shareholders, minimizes the funds being locked in IPF, addresses both income-oriented shareholders as well as growth-oriented shareholders, and it's a balanced tax impact between the company and the shareholders. Now, the next question which is being asked to us is, does buyback really create value? इसका आंसर cannot be a simple black and white. Again, इसका आंसर भी simple yes or no नहीं हो सकता. Directly, it does not. There is no direct correlation between the buyback and the shareholders' value. इसमें भी again I'll go to the Pawan sir's presentation only, wherein intent defines the object. Outcome would be the statement, because we understand that the ratios improve and accordingly the inherent value changes, but intrinsic value of the company remains the same. Value creation depends on the buyback price in relation to the intrinsic value. Buyback does signal a management confidence, the confidence of the management in its own company, and thus to the shareholders as well. And accordingly, it requires evaluation of cost of funds vis-a-vis the expected returns. Just taking a simple example, if the price of a company is presently 600 rupees, whereas earlier it was ranging in the range of 800 to 1000, the dip is purely on account of the current market conditions, the war situations and other things. And the company decides to come out with a buyback at 850 rupees as against the running market price of 600. This situation will definitely boost investor confidence and will ultimately be reaching to the shareholders' value as well. So when we talk about impact on the shareholders, there is an impact by way of better dividend yield and the total return. When we use the funds for returning the value, it means we are utilizing the funds better utilization of funds. This would lead to boosting the ratios, EPS, return on capital employed, and thus better capital efficiency, thus leading to enhanced shareholders' value. Now, impact of the buyback announcement on market sentiment. हमने बहुत बार देखा है कि जिस दिन कंपनी अपना बायबैक अनाउंस करती है, the market price goes up, but again after some time it starts to come down as well. So what is the impact? Is there again a direct correlation between the two? The answer to this would be there is again no direct correlation between the two things. If you're declaring a buyback and you feel that from tomorrow onwards the market will start to go up, answer is it may happen, it may not happen, depends on lot many other situations wherein the company is playing. Does a buyback mean that the company has lack of growth opportunities, or company has no better options of using the money than it is wanting to return value to the return money to the shareholders? The answer to this is a big no. The companies do imply buybacks do imply absence of growth. Companies continue to invest while returning value to the shareholders. Buyback regulations tell us that only 25% of the net worth, paid up capital and reserves can be bought back. Balance 75 the company still has for utilizing towards for putting in towards the capex and future expansion. So nothing like that the company does not have better utilization of funds. एक क्वेश्चन हमारे पास ये भी आया था कि do buybacks are buybacks biased in favor of a particular category of shareholders? Are they in favor of promoters or in favor of big category shareholders? Again, the answer to this question again is a big no. Buybacks, I call it a very righteous mode of returning value to the shareholders, wherein every shareholder of mine is eligible to participate. In fact, in tender offer route mein to there is a 15% reservation for small shareholders as well, wherein even the small shareholders are getting better chances of their acceptance. Open market buyback, everybody can participate if it is reintroduced. Then in tender offer route, promoters can also participate. Herein, promoters are also getting an equal opportunity to participate. So their equal opportunities are given to everybody to participate in the value distribution. Now, what would be the impact on my balance of the buyback on my balance sheet or on my ratios? This is a very simple example, very simple balance sheet we have taken, which is not the case. And normally in case of any of the listed companies, if pre-buyback balance sheet was 1,50,000, which comprised of 1 lakh of capital and 50,000 of reserves on the liabilities side, and simple cash of 40,000 and bank balance of 1,10,000. And the company announces a buyback of 2,500 shares of rupee 10 each at 20 rupees. That is, buyback value is 50,000 rupees. My capital would accordingly be getting reduced to 7,500, 10,000 minus 2,500. Very simple. There would not be any impact. The reserves would be gone off to the total extent. And a CRR, sorry. And in my balance sheet on the liabilities side, a capital redemption reserve to the tune of the nominal value of the shares which have been bought back would be created, 25,000. My balance sheet size gets reduced to 1 lakh rupees. Basically, जितने का मैंने buyback किया, उससे मेरी balance sheet size reduce हो गया. It leads to reduction in assets, thus increase in return on assets, reduction in equity, thus increase in return on equity, increases the EPS and improves the company's PE ratio. Stock market impact, because we are talking about listed companies, so market impact is the most important aspect. It definitely leads to a positive reaction. It supports the running market price, which in totality ultimately lead to investor confidence. These we have discussed about the major modalities of a buyback, but since we live in a regulated environment, we cannot ignore, we cannot avoid the regulations and the act provisions. So that is again an important aspect of it for every company to understand. So modes and process of buyback. Quantum of buyback, if we have to do a buyback up to 10% of the net worth, only a board resolution is required. Shareholders' approval is not required. But if we want to do the buyback of more than 10%, a shareholders' approval is also required. Simultaneously, maximum of 25% of the net worth can be bought back in a financial year. In a tender offer route, 15% of the shares, as I said earlier as well, are reserved for small shareholders. While in open market, there is no such reservation. When we talk about modes of buyback, presently, it is only the tender offer route and open market through the book build process. We haven't seen any book build process buybacks. Majorly, all the offers ever since 2025 are being through tender route only. And promoters can participate in a tender route buyback. As we said earlier, there is a discussion paper which has been floated by SEBI, pursuant to which they plan to reintroduce the open market buyback. And I'm sure once this happens, whenever it happens, once this happens, we'll see more traction in the buyback, number of buybacks and the amount of buyback. Pricing, tender offer, it's freely priceable. We have seen cases of buyback premium to be as low as 10% and even as high as 50%. So it is freely priceable. The only thing is we have to give a justification in the letter of offer as to on what basis we have decided the price. When we talk about a book built buyback, an upper end and a lower end of the price range is needed to be provided, and the final price is fixed depending upon the price discovered through the bids received. When we talk about the process flow chart in case of a tender route, the entire process gets completed by and large within a period of 45 days. The first one being appointing a merchant banker who conducts a due diligence and issues a DD report. And then once the board meeting or a shareholders meeting is done, then everything is required to be done within a period of 2 working days, 2 working days or 4 working days. And accordingly, the process gets completed. When I say completed, पोस्ट इशू एडवर्टाइजमेंट तक की बात कर रही हूँ, पूरा का पूरा प्रोसेस कंप्लीट बाय एंड लार्ज 45 डेज में हो जाता है. द टेंडर ऑफर हैज remains open for a period of only 5 working days. That again is an important aspect. There is no leeway for increasing the offer period. It remains only 5 working days. Book built, although as I said, we haven't seen any book built to buybacks, but the process by and large remains the same. The only difference is here the offer remains open at least for 2 trading days. Maximum has not been defined by SEBI, but at least 2 trading days it remains open. Rest everything else by and large remains the same. Now, tax implications. I'll not be getting into too much details of the tax because RK sir is there with us. But some of the exam of the major amendments, now it will be taxed as capital gain. Only the gain portion will be taxed, not the entire proceeds would be taxed. Then it, depending upon the holding period, long-term or short-term gain would be applicable. This is all for public shareholders. For promoters, there is a different tax regime altogether. For promoters, there is a tax of 22% or 30% irrespective of long-term or short-term, plus a surcharge of 12%. Again, this illustration I'll not be taking up. RK sir would be the best person to explain all these things. So to conclude, a buyback done, it is all a question of right being done. A buyback done at the right price, at the right time, for the right reasons is not a return of capital. It is a statement of conviction. Optics versus real growth would be visible from how the management perceives and why the management wants to go ahead with the buyback. That's it from my side, sir. Over to you. Thank you.
Okay, thank you very much, Anjali, for giving this presentation. As you are aware that the technical part is there, but when we do the buyback, the first question comes, why? And the promoter is always asking, and everybody is asking about the tax, and what and why and how. So whenever Manoj is there and other people are there, when we do merger, so the one questions when we are finalizing, these are the advantages to the company. One issue is always stamp duty. So anything which is outflow, always people ask this question. So now, RK sir, you are here. In your absence, we have given your introduction. RK Agrawal ji is a chartered accountant and tax consultant, one of the best consultant in India, and he is our partner also. And RK has done lots of research, lots of things, and his command over subject is superb, and which you can see. RK, now because you can cover the buyback taxation, but I have just posing some question. The before 2024, there was an old regime, and when company has to pay buyback tax or charges, whatever you name, then they have shifted to 24 to 26, 31st March. Shareholders was doing, and now from 26 April, now new regime has come where they are putting so many restriction to the promoter and they're charging heavily on the promoter. So promoters is totally unattractive. So that is one question, that why, what are the changes, why they have done changes. And the second is that when they have done this, then the buyback will be unattractive, then dividend will be attractive. So dividend is also taxable in so many aspects. So you can just tell us the journey of this tax. How should we do as a promoter if we want to do the buyback, whether it's a useful or not, to whom it will be useful, and why this tax theory is going on in the country. What is the jurisprudence of tax that going up and down reason? Over to you, Arif.
Thank you, Pawan. Thank you very much. In fact, when we are discussing the provisions relating to taxation of buyback, if we go to the past and see the taxation policy of the government with respect to income tax on share buyback and dividend tax, and there have been so many somersaults, so many changes during last decade. I mean, there was no stabilization in the policy. Initially, we can say prior to 2020, there was a system where dividend distribution tax was levied on the companies. No dividend was taxable in the hands of the shareholders. Company was paying dividend distribution tax, which was initially 15%, then it was increased to some extent. And share buyback tax was also applicable on the corporates, not on the shareholders. Dividend distribution tax was abolished and dividend became taxable in the hands of the shareholders. Maybe in the year, I don't exactly remember, it was somewhere in 21-22. But so far as the taxation of buyback on shares was there, it remained with the company of itself, not in the hands of the shareholders. So what people started doing, that instead of paying dividend, because the rate of tax of dividend was higher, for the small shareholders, it was low because it was as per the slabs in the income in which, the slab of income in which the shareholder is falling the. But in the case of promoters, primarily they were in the highest tax bracket. Therefore, the rate of tax was higher. But the rate of tax of on buyback of shares was low. It was 20%, and that too by the company. So effectively, for the shareholders, the impact was even less than 20. So maybe around 15-16%. So instead of paying dividend, many companies, what they started doing, they started buybacking shares. And by way of buyback the shares, they started distribution of the funds, distribution of the income to the shareholders. And primarily the advantage was being taken by the promoters. That was the objective of the promoters. And instead of taking the dividend, you go for the buyback of the shares, and that way you can distribute the income to the shareholders and paying lesser taxes. Government wanted that on dividend, full rate of tax as applicable on dividend should be paid. So the point is that in the garb of buyback, shareholders were being awarded by paying the dividend, by getting the distribution of the income, which government thought that it is in the nature of dividend. Therefore, with effect from 1st October 2024, they made the amendment when this new regime of the Modi government third term came. First budget was there in July 2024. They amended the provision, and by making this the amendment in the provision, what they did, they made the buyback of shares very stringent, very stringent. So it became taxable as dividend in the hands of the shareholders, not now taxable in the hands of the company, but to the shareholders as dividend. Dividend, if it was being paid to the promoters or to the highest income group shareholders, the highest rate of tax was applicable. And apart from this, the cost of acquisition of shares was also not allowed to be set off against the amount of buyback received, because it was being taxed as a dividend on the whole of the amount. There was taxable liability as per the slab of the shareholder, but no benefit of the no benefit of the set-off of the cost of acquisition of the shares could be taken by the shareholders. That was being regarded as a capital loss, because the cost of acquisition has now extinguished, against which whatever the amount was received from the company was being taxed as a dividend. So this amount was being allowed as a capital loss to be set off against any other income in future under the head capital gains. So this provision was quite illogical, quite absurd. So in this year's budget, 2026 union budget, they realized that this provision is not correct. They have reversed this provision, and now the new regime has been brought. Now, what is the objective? The objective of this new regime is that whenever there is buyback of shares, so either it is being given for giving the share buyback is being done for giving the benefit to the promoters. This is the assumption on the basis of which new tax regime has been incorporated, has been enacted. So the point is that if you are other than promoter, then it is taxed as a capital gains. Now with effect from 1st of April 2026, because now new Income Tax Act 2025 is in place, and according to the new Income Tax Act, now the concept of previous year and assessment year is not there, but tax year is there. So now 26-27 financial year is the new tax year for the purpose of the applicability of the provisions of the Income Tax Act 2025. Now, new Income Tax Act has become applicable from 1st of April 2026. Sorry, 2026. So, in the case of non-promoter shareholders, it is being taxed as capital gains. Non-promoter shareholder may be either company, partnership firm, or individual, whosoever it may be. It will be taxed as a capital gains. Now, if it is capital gains, then whatever the rate of tax is applicable on capital gains, that would be applicable as per the slab, or as per the nature of the entity, or as per the nature of the capital gains. It may be short term or it may be long term. If it is long term capital gain, means the holding period in the hand of the shareholders of the shares which are being bought back by the company is less than 1 year, then the tax would be short term capital gain. But if it is more than 1 year, then it will be taxed as a long term capital gain. On long term capital gain, 12.5% tax is applicable. On short term capital gain, 20% tax is applicable. So whatever the rate is applicable, that would be applied with effect from the 1st April 2026. But even here, the legislature has made the provision that if shares bought are being buyback is being done by the corporates, then for the promoters, it will still be taxed in the nature of dividend. So rate of tax in the hands of the promoters has been enhanced. Whatever the normal rate plus additional tax they have provided, so as to bring the tax in the hands of domestic promoter, in the hands of the promoter, which is a domestic company, up to 22%. And in the case of the promoter who are other than domestic company, then it would be 30%. So if the applicable rate is 12.5% of long-term capital gain, then if you are a promoter, then additional tax would be there. If you are a domestic company, then additional tax would be 9.5%, so that the total tax becomes 22%. And if it is non-domestic company shareholder, then it would be additional tax would be 17.5%, so that the total tax becomes 30%. So they want that the highest rate, which may be applicable for dividend in the hands of the individual or in the hands of the domestic company, that would be attracted in the hands of the promoters. So the provision is again not very logical. Again, I mean, to assume that in all cases the buyback of shares decision is taken by the corporates to pay the deemed income in the hands of the promoters, which otherwise would have been distributed as dividend. I mean, this kind of assumption is not realistic. Though certain companies were making misuse of this provision, and therefore such stringent provisions were brought earlier, and now again when they have relaxed for non-promoter shareholder, but for the promoter shareholder, they have not yet relaxed the provision. And the only thing is that the benefit of cost of acquisition would be available to them also, which was not there in the earlier regime, when for 1.5 years, I mean, the other provision was there. Secondly, a question comes that who is promoter? Again, to see that who is promoter, they have defined in section 69, subsection 3, that if it is a listed company, then promoter would be what has been declared in the as per the SEBI Act, Securities and Exchange Board of India regulations of buyback of securities. There, what promoter have been defined, and generally the promoter have been defined a person who is having a control over the company. It may be he may be in the capacity as a director or in the capacity as a shareholder, but the person who is having the control over the company may be the promoter. So in the case of listed companies, there is no threshold of the shareholding percentage, but to be the promoter. So whatever the definition has been given in the SEBI Act or in the buyback regulations, that definition would decide whether you are a promoter or you are not a promoter. But in the case of non-listed companies, there are two criteria. One is that whatever the definition has been given under section 2, subsection 69 of the Companies Act 2013, or a person who holds directly or indirectly more than 10% of the shareholding of the company. So here, for non-listed companies, they have given a threshold of the shareholding also. That if there is a shareholder, he may not having the control over the company, but if the shareholder is having more than 10% of the shareholding, he shall be deemed to be promoter for the purpose of applicability of tax on buyback of shares. And in his case or her case, the applicable tax rate shall be as per the tax applicable of the promoter. So again, I mean, there can be a question mark on this issue also, that a shareholder in a non-listed company may hold more than 10% shareholder without having any participation in the management or having any kind of control over the company, but still for the purpose of taxation of buyback of shares, the rate of tax shall be applicable as a promoter in his or her case. So these are the basically provisions which have been made. So as I said in the beginning, that there has been somersault by the government, by the legislature, so far as the taxation of applicability of taxation, income tax on dividend and buyback is concerned. now on dividend, there is a stability. It is taxable as per the slab rate in the hand of the shareholders. It is taxable as per the slab rate. It is taxable. So I think that part maybe now stable and may not tinker again in future. But so far as the tax on buyback is concerned, still there are certain irrationality which are inbuilt in the present system, which has become applicable from 1st April 2026, and maybe that in future certain more simplification or rationalization is done in this regard. One more thing, that set off of losses. If there are any kind of losses which are available under the head capital gains, since now buyback of shares proceeds are taxable as capital gains, that set off shall be allowed to be adjusted against the income of the buyback. And after that, whatever the net remains, on that only, even in the case of promoter also, it will be allowed. There is no problem. Cost of acquisition will also be allowed to be set off. There is again, there is no controversy. There should not remain any doubt so far as this aspect is concerned. So these are all the provisions in nutshell. In case there is any kind of question or query which is still remaining, I will be pleased to answer. Okay, over to you, Pawan.
Thank you very much. Thank you very much, RK, for giving detailed tax aspects of domestic and non-domestic companies and the listed and unlisted promoter definition, set off of the losses, and then the additional burden on the promoter, pre-regime and new regime, and the from 1st April. All these things are there. I have so many questions. I will ask you during the question hour time. Now it's time to discuss the one of the I think we always take name of that company very respectfully, and anybody who is the company secretary of that company always think that when a company is selecting this person, then something is great. I remember Mani, I'm referring about you, when Mr. Narayan Murthy came for corporate governance award in our institute, when they gave the award to them, then I think he has taken his company secretary name around 10 to 15 times, and he mentioned that that entire thing is governed by our company secretary to decide. And interestingly, the most important thing which he was mentioning, he was not mentioning about the what is the compliance part he's doing. They were talking about the strategy. They were talking about the governance aspect. They were talking about the how the strict board procedure is there. Now, over to you to discuss that how you see on the governance aspects this buyback law concept on a strategical basis, and what is the future of this buyback process, because you are deep into this, you know the law, you know the things, and you know the questions which board people are asking when you are bringing out anything relating to your company, earlier company, and in the market. So what is your view? Over to you, Mani.
No, thanks, Vijay. First of all, many thanks for having me here. It's a pleasure to be associated with your panel. I'm greatly honored to be here. And many congratulations for your 6th anniversary. So I wish you many more successful years to go ahead. Just a standard disclaimer before I start, the views which I provide during this session is my personal views and it's not my employer. I know though you have called out the company, but I would restrict to provide my personal views rather than the company view. And this is only for an academic purpose, nothing beyond that, right? I think most of the things you have already covered in your presentation, Anjali covered, and Mr. Agarwal has covered from the taxation perspective. But what I would like to do is I would like to give you some strategic insight or probably a win-win situation for all the stakeholders of how this buyback can operate, right? Now, what I would like to do is if you see from a lens of the company, what can it be? How can the buyback help a company? I think most of your presentation, if you covered the examples of the Apple, the TCS, Wipro, Infosys, etc., right? So now all these companies market capitalization, if you see, barring from the last 3 to 6 months, what we have seen the downturn, consistently year on year, the valuation kept growing, right? The market capitalization got building up year on year. That is because there was a principle of capital allocation policy. They used this buyback as a strategic instrument or a strategic point of view, so that there is a complete discipline of capital allocation. So they have articulated their long-term strategy of how they are going to allocate that capital. There is a clear thinking of how much will be allocated for operational purposes, for how much they will use for innovation or for the M&A or for business expansion purposes, etc. And whatever unutilized cash, how are they going to return back to the shareholders is something which they have clearly articulated in their own dividend distribution policies. And the capital allocation policy speaks about the dividend distribution as well, right? So if there is a surplus arising beyond the dividend distribution, what they have articulated, it can come into a capital, it can come as part of a buyback. The advantage of stating this upfront as a policy and a long term, if you see the investors, the long-term investor would actually need a fiscal discipline, or he should have a predictability of what income he can generate over a period of time. So by articulating how much dividend I actually give it to the shareholders, or what will I do with the surplus money which will be available after all the dividend or whatever cash I generate, will gives a predictability to an investor. So therefore, any long-term investor would actually look for this and probably stay invested for a longer duration. Right? So that's the point which most of these companies which you showcase have utilized it with very effectively. And if you see, I don't think many of the companies have used this as an opportunistic, like the way you have articulated in one of your slides. Though in certain times to boost the confidence of the market or to be more of an opportunistic, there may be a few examples, but I think the big companies have actually stated what and how they do it. How do they allocate their capital? And we have also seen in a few companies, the way they have done it is, let's say if there is too much of cash and they don't know where to deploy the cash, they have utilized probably some this cash which gets accumulated over a period of time. They have come out and invested or returned the capital to the shareholders. So that's the strategic point which the board thinks from a long-term perspective. This also attracts the investors, as I was saying, the long-term investors, especially if you have a government funds, if you have pension funds, they look at from a capital appreciation point of view, because if they don't participate in the buyback, that's fine. They will still be a beneficiary of the outcome of it, which means that the EPS can improve, the return on equity can improve, because they are people who are invested for decades or for a long-term perspective. Therefore, they'll be beneficiaries of not participating in the buyback as well, right? So that's another way of looking from an investor standpoint. I think we spoke about the return of equity and the EPS. It is helpful for both from a shareholder perspective, because if he has not participated, he will stay invested and get benefit of over a long period of time. And it will also help the company because their EPS will naturally go, and therefore it will translate into a market capitalization, right? So I think that's the way I would see from both from a company perspective and also from an investor or a shareholder perspective. Now, there are many advantages when you come to the investor perspective as well. Right? So one is, if you're participating, of course, you will get benefited because you'll get a premium on the price, especially if it is in a tender route, you will have some kind of a premium than the prevailing market price. And then second, if it is on an open market buyback, again in open market buyback, if your shares get tendered, then it is on the same uh, level of the market price which you have. So therefore, you get benefited out of this. The good thing what has happened from the recent tax changes, the way Sir was articulating, is the capital gains is treated the same whether you are participating in the buyback or if you are selling in the market. And another opportunity is more from a small shareholders perspective. As we all know, there is a 15% reserve category. So they get a little more premium, or the winnable, or the number of shares which gets tendered will be more than the normal shareholders. So that is another small opportunity the investors, I would say. And also this also gives you an exit opportunity for many of the promoter shareholders if they don't want to sell it in the market, if they don't want to take shots at the pricing, etc. So probably this is a good opportunity where we have seen the large corporates where there's a big promoter shareholding. They have used this as an exit opportunity in most of the cases, where it is also a discipline. So over the period of time, they know how much shares can be sold, and therefore it becomes a predictability standpoint from the promoter standpoint as well. So I think those are the points which I would say from both the company point of view and the shareholder point of view. Having covered that, let me cover about the execution standpoint. Given all our professions are mostly into how do we execute, right? So I think the laws, both from the Companies Act and listing regulations, are very prescriptive, especially in the listing regulations, very prescriptive, very time bound. And it's very well articulated legislation, I would say. And all the more if you engage the banker, right? So right now you need to have a banker, merchant banker, to run through the whole program, who will have the primary responsibility of running the compliances. It becomes very easy for any compliance officer to plan ahead to do what has to be done on what frequency and what forms has to be filled out to which regulator. Given that there are a number of steps, it gives you a very good flavor of different aspects to look at it, right from filing the forms from material disclosures perspective, right from timely disclosures or the event-based disclosures, shareholding pattern. So there are a number of disclosures or the compliances which has to be done. So therefore, it gives you a great opportunity for our professionals to look into it more carefully. I think with that, I will hand over back to you, Paul.
Thank you very much, Mani. As expected, the way you have discussed, and I was also telling the dividend has a policy, same thing should also have the allocation policy. And the point is right, you require money for operation, you require money for innovation, expansion. These are things, even after it is lying there. And the best example of Apple, we have seen that Apple investors are always asking that you are not investing, that money is lying with company. What is the purpose? Give it to us. And I think one time the investor has forced Apple to give and buy back this through the dividend.
Yeah, Pawan, just to respond on that point, see, unlike in India, in the US, there is no requirement to come out with all the disclosures what we make, right? There is a prior intimation which has to be done before the board convenes, and then after the board convenes the meeting, we need to make a disclosure, and after that, the shareholders approval. After that, you need to come out with offer letter. There are multiple steps, but unlike the contrast, if you see in the US can just announce to say that, okay, I keep buying the shares throughout the year. So that's the advantage. Many of them, in fact, Microsoft, Apple, all these new age digital companies have actually used this very effectively. And therefore, whenever they see this an opportunity to buy back shares, they keep buying back. And that's the big difference from an Indian regulations and the US regulations. And I think that's the point why our regulators, like for instance, right now, if you see MCA has also come out with this mentioning that we will allow more than one buyback per year.
Yeah.
Maybe that's the thinking. They have taken some guidance there, and probably that's the thinking which probably we will see a light of the day towards that.
So Indian regulator always think that you should not do arbitrage. You should do for this purpose you have brought out that you focus on. And I was reading this USA flexible board driven market based. In India, we have more on shareholders approval, other thing, but UK is also giving this. That is another aspect that they are asking. So, no doubt they are more flexible, but everybody disclose and discipline in the market they require. That is the most important thing, and intent of doing this. So let's. So thank you, Mani. I will come back to you because I have so many questions and various questions are already there. So my request is all the all the panelists, they when they are not speaking, they can see the questions when the question will come, so we can have less time to repeat this. Okay, now Vijay, you are working in a company and you are working in a new age company, I will say, a
Yeah.
startup company. When they have started, the startup was there. Now, so what is the theory which Money has mentioned on this? Money has a they when they are doing anything in the India, they have to see the entire world also, because there are so many companies, so many things, so many explanation investors. Now you are also having a big chunk of FIs, investors, other investors. So what is your thinking on this particular aspects? Anjali has covered the legal part, RK Agarwalji has covered tax part, Money has covered the governance part, and specifically why I want to do. So your view on this, which is also important as a startup, new age company, what is their thinking, why they want to do this, is there any advantage you got it? All these things. Over to you.
Yeah. Before I start that, I should thank corporate professionals for giving me an opportunity to participate in this webinar. No, before I start, a company which I work is matrimony.com Limited. It is in existence for the last 26 years. It's not a company which is formed recently. We have been there for the last 26 years. And we got listed in the year of 2017. So it's the only company listed in this space. We call ourselves as a consumer internet company.
So you have come late. That's why you we all are seniors. Okay.
So in that aspect, see, we are basically, the company is a subscription-based model. So we receive money in advance so that we don't have the problem of debtors or AR. We are a debt-free entity. So these are some of the reasons where we generate significant amount of cash on a yearly basis. So we are a mid-sized firm where our turnover is around 450 to 470 crores, and we generate a profit of 40 crores on an average. So, as you said, since the cash gets generated and gets piled up, at some point of time, also to point out, we came out with listing in 2017 at a price of 985 at a 2,100 crore valuation. But subsequently, due to market conditions and other things, the price keeps dropping, and currently we are trading at around 450, so it's almost half the price. So in a way, it is very important for the company to think in the perspective of the long-term shareholders also, and also the retail shareholders. We have to return excess cash to them. That is a primary objective of our capital allocation policy, returning excess cash to the shareholders. We have been doing buyback since 2022. That was our first buyback. At that time, in the taxation point of view, from the taxation perspective, the company has to bear the entire buyback tax. It's around 23% at that point of time, I believe. So subsequently, after that, that time we had a subscription of around 7 times. So we being a mid-sized company, or with our net worth, we were able to offer at 1,150 rupees per share. It's a high price when we are trading at around 600 rupees, almost more than 50 to 60% of premium we gave. So it was an overwhelming subscription in 2022. But as he said, we have been consistently giving dividend of also 100%. It's a dual perspective. from the capital allocation point of view. We are giving dividend also as 100% plus buyback almost every year since the last 3-4 years. From 2022, 2024, now in fact in 2026, recently we completed a buyback. So the difference what we see is the only objective from the promoter's perspective is to return excess cash to the shareholders. And since there are long-term shareholders who have been associated with us for more than a decade, we need to also give a return so that they continue to stay with us. And more importantly, even due to change in the taxation, I don't see any difference in the subscription part. Even retail shareholders, all the long-term shareholders, both subscribe well, even during this difficult taxation part. In both times, in 2024 as well as 26, we had around 6 to 7 times of oversubscription. So I don't think so. This doesn't alter any subscription thing. It is continued to be the same level only. So the another important thing what we feel is now in this current scenario, now SEBI started directly asking questions on the to the company. That is a new thing which we actually learned. Usually they generally ask questions only to the merchant bankers. Now we are getting emails and clarifications directly from the company, which I see this time in 2026, which is completely new. From in the 2022 part, when we came out, there was a regulatory standpoint. We were supposed to file the letter of offer with SEBI. We have to wait for the approval from SEBI. We'll have to wait for the approval. Since the procedures have been streamlined and the process have been reduced, the buyback process just takes less than 2 months. We were able to complete buyback in less than 2 months. So what we see is we are trying to see we have excess amount of cash, and in the near future we don't find any better way to invest, maybe in technology or in any other acquisitions. So maybe the management thought it is best at least to return the excess cash to the shareholders. That is the primary objective. So from the standpoint of matrimony.com Limited, the promoters don't participate in any of the buyback. So that is very critical point. They don't participate. Their portion is also given to the to the retail and long-term shareholders. So that was the primary objective. There, apart from this, since we also continue to maintain our dividend of 100% every year, apart from the buyback, which we continue to do. So these are some of the perspectives from our side. But the only thing what I could see is from the regulatory standpoint, the filing of forms with the register of companies, what I see is the amount of documentation and clarification sought by register of companies for filing forms have become a little headache for the companies, because the forms have got certain restrictions on uploads, and they ask for the entire list of shareholders, and they also ask the balance sheet, which is already filed as through AOC4 and things like that. It is actually becoming difficult for us to file the form on time. In one particular case, even we faced rejection of a form which we have to file once again. So these are some of the challenges which we underwent in the last buyback. Apart from that, the buyback process has been smooth, because we have been guided by the merchant bankers, and it's all preset timeline. So we don't have any room for errors. Everything goes as per the thing, and buyback has become seamless. So these are some points which which I thought.
Thank you very much, Vijay. You have mentioned and given, and the interesting point which you have mentioned, that now regulator is not allowing what is written in the law. They want to see if they are asking any question, it means they want to check your intention. So any company's intention, that why you want to do this, what are the issue. So initially I mentioned that now the strategy is there, but intention is also very important. Thank you very much for giving this. I have some few questions which I'll ask you.
Sure.
Now, Sandeep, you have done various, I think, buyback in this. So I want to understand from your side. Sandeep, you're there? Okay. Sandeep should tell. Yeah, Sandeep.
Yeah.
Sandeep, Now we want to listen from your side, your story, your thought process, and your experience.
So, first of all, thank you for having me. It is my privilege to share this panel with such distinguished voices of Mani Bhai and Shankar Bhai and you yourself. So, on this subject, which we sits here as an intersection of corporate law, taxation, policy, and market microsystem, and one that has seen more regulatory changes and movements in last 24 months that perhaps we have seen so many changes. So changes in Finance Act, then Finance Bill, point of taxation. So with this, I'll start that before saying anything, all whatever I share it my personal on my personal capacity and nothing in relation to my employer. So everything is already said by all the speakers about how regulatory work, what is the taxation, and how this buyback helps the company and what it should be. So I just share my personal experience on buyback, wherein what I see that India has two kind of companies. One are top nifty, those are promoters driven conglomerate, behave in a different way, and others are the small cap companies and mid cap companies. So they decide, their board decides in very different manner. So during my experience in the board, it is very challenging to tell the board how and why we should go for the buyback and not for paying dividend or do the bonus. So these are the challenges we face in our board with our board. So everything is already being taken up by all the panelists. So I say you to kindly proceed, Tony.
Thank you, Sandeep. Thank you. I will ask you some questions later on. Manoj, your view on buyback on a strategical basis, specifically covering takeover aspects and the valuation aspects. Okay, so takeover aspect is that my holding is 60%, and now I'm doing buyback, and my holding is becoming 67%. Whether takeover code is applicable or not, and how I will handle this, and what is the exemption, whether it is allowed or not. So this point and the valuation. When we do this, then we require valuation. So registered value is required, valuation is required. Your view on this?
Good evening, everyone. I think there was a very detailed discussion. Anjali ma'am has given the presentation, and then obviously Mani has given very good insight about the governance structure and logic behind this. And RK sir has given elaborate journey of taxation, which has made this topic very interesting for all corporate professionals. So we have to understand, though Anjali ma'am has given a detailed discussion relating to the listed company, but there are unlisted companies who also plan strategically buyback in many cases. And that is also very important, like to give exit to certain individual shareholders, maybe sometimes the fund or VC funds which have invested earlier, and they cannot get exit because of the market condition or otherwise. So they need, the company has cash, but as per the law, as per the understanding, they need to come out with IPO within 3 year or 5 year, which has gone, and they now need asking for exit. So in such cases, obviously, company can plan buyback, and that scenario, that the legal provision relating specifically the taxation has impacted it several times. When it was dividend distribution tax payable by the company, a special rate was there, and that was payable by the company. It was very simple. Exit can be given to those shareholders through targeted buyback, and there the taxation aspect was also not impacting the investors. Then it became dividend distribution tax and payable by the individual particular shareholders. So it became very problematic to them. The shares are getting cancelled, so it is a capital loss, but it was not getting set off against any capital gain, and the tax rate was also very high. Now this anomaly has been changed, so amendment has made it very simpler. It is now a capital loss or sale of asset, and if there is a capital gain, it has to be paid in as per the capital gain tax rate, which is for long term it is 12.5%, and for short term it is 20%. So considering a private company, it will be 2-year period, holding period is there, then it will be long-term capital gain, and the rate will be 12.5. Now there is a trick that they have defined the promoter and differently, and for that also they have also put a special rate of tax, additional rate of tax, which has made it very difficult for many of the company where the investors have more than 10% shares. One investor has more than 10% share, then they will be deemed to be a promoter, and in such cases taxation will be higher in their hand. So whenever a person is categorized as promoter for short-term capital gain, the tax rate would be around 30% for individual and other than company, domestic company, and for company it will be 22% plus surcharge as may be applicable to the company. So in case of non-promoter, yes, it is very beneficial to those persons. They can take exit at a capital gain of 12.5 for long-term capital gain and 20% for short-term capital gain. So that makes planning easier for such companies to give exit to the shareholders, smaller shareholders. For listed company, obviously it is as we have already discussed in detail. So it is a matter of strategy, what impact it would have on the share capital, EPS, and then capital structure of the company, and whether it is beneficial to go for reducing the paid-up capital base or not. Those are the planning part. So that happens. Now as you are asking specifically with respect to the takeover law. So under the takeover regulations, there is a specific exemption under section regulation 10.3 and 10.4. 10.3 applies to those cases where the promoter's holding is less than 25%. And in that case, or any person who is holding 20% or 25% or less, and due to buyback, their holding is going beyond 25%. In such cases, there is a straightforward law that the person need to come back to less than 25% within 90 days. Otherwise, they have to give open offer. So exemption is only for 90 days here. The other situation where the promoters are there, existing promoters who are holding more than 25% share in the company, and in that case, the exemption is also available in case their holding goes beyond 5%. That is the creeping limit for the financial year because of this buyback. Selective buyback means if they are not participating in the buyback and their holding goes beyond 5% limit given. In such cases, they can get the exemption only subject to the condition that in case it is a board approved process, all the directors representing the promoter group should not participate in and vote in the process. In case it is going to the shareholders, the entire promoter group should not participate in the voting process of shareholders meeting. And also there is no change in control. So if there are two group of promoters and there is change in control because of this, then this exemption is not available. So these exemptions, if these conditions are getting fulfilled, then there is a specific exemption available under 10.4 of SAST regulation. If these conditions are not getting fulfilled, then in that case, 90 days period is given. So you can continue with the extended holding for 90 days or come back within that period, within the limit of 5% creeping limit. Otherwise, you have to give open offer on the 90th day. So this is the legal position with respect to takeover regulations. So that is very much clear. So I think broadly, we have already discussed most of the things relating to the valuation. Yes, there is no specific valuation parameter given under the regulation. However, it is said that the board must consider what is the basis of fixing a price. and for that they can take support of the valuation report by a registered valuer. So in same goes for unlisted company also. Now all kind of valuation for the purpose of any corporate action has to be by the registered valuer only. So you have to take a valuation of the shares from a registered valuer registered with IBBI, and place this before the board of directors and at the time of fixation of the price. But the law does not say that if the valuer is giving X price, you have to give offer at X price. You can give at higher price. You want to give premium, that is also allowed. So and obviously to make buyback attractive, you have to give offer at a price which is higher than the market price. Otherwise, people can go and sell in the market. So all the companies which are adopting the buyback option through tender route, or if the open market route is started again for listed companies, that will be at a price higher than the market price. Then only it is beneficial to the shareholder. Otherwise, they will sell in the market and get exit. And now it is totally at par. Whether you are selling in the market or you are selling in the tendering in the buyback offer, it will be at par for from the tax point of view. So there is no difference in that. That is the broad thing. I think we can have a question answer, and I think some questions are also coming relating to these things.
Thank you very much. Thank you very much. So now, friends, I'm starting a question answer. So please be a little. RK Agarwal ji, so many questions on taxation. Okay. So now, Anjali, is buyback fundamentally value creation tool or just a capital redistribution tool?
Value distribution, sir.
Okay.
Not just a reduction tool.
Okay. Vijay, Mani and Sandeep, your view? Mani, is buyback fundamentally a value creation tool or just a capital redistribution tool?
No, I think the way to look at it is little different, right? So the capital allocation is a means to get the valuation, right? I would put it like that, right? So value creation is a more long-term strategy. I think one of the fundamental is the business is very fundamental. I think you can't compromise on the business. Business has to be there, and only upon when your business is good, then you can create the profits, and only a portion of profit can be allocated to the capital allocation, and that can be a means to create a valuation, and it's not the only means to create the valuation. This can be one is what my view.
Okay. Vijay, you have any point on this?
Yeah, because according to me, buybacks are best done when the company grow consistently and generate good amount of cash. If the growth is not there, and then you have to be very careful about your future requirements also. So at that time, it may not be a good decision to go for buyback. And if you have planned to invest on mergers, acquisitions, and technology and things like that, I think buyback has to go a step back. So that is my view.
Okay. Sandeep, do you have any view on this?
Pawan, can I?
Yes, RK.
Yes. Whether we can say that buyback, if we are having surplus cash in the company, then buyback can be adopted as a tool. To my opinion, to distribute surplus cash cannot be the objective of buyback. If surplus cash is available, then it has to be distributed as dividend. In case of buyback, there are other considerations other than distribution of cash. Then restructuring of the shareholding or enhancement of the valuation. I mean, there may be certain other parameters. It cannot be said that since we are having surplus cash, therefore buyback is being done to distribute the cash.
Right.
And that was the misuse due to which the government stepped in.
Okay, Sandeep, your view?
Yeah, it should be an value creation. So via buyback, we do not see only that we rises the price of the share, or only instead of dividend, some tax saving is there under buyback, which government decided to curb and followed with this rule. So it should be long-term value to the long-term shareholder who are being with the company and wanted to being with the company more than 10, 15 years. So it should be treated as a value creation tool only.
Okay.
I think it is also part of the strategy. Like I was discussing many of the cases for private company, especially exit opportunity need to be given to certain class of shareholders, and that can happen through buyback easily. So selective buyback is done in many of the cases where the timeline is going and you cannot come out with the IPO within that time frame.
Pawan, may I just ask one question here, a relevant question, that whether selective shareholder buyback is possible? It is permitted in law that you offer buyback only to the selective shareholders.
So no, sir, offer is given to everyone, but they do not participate. Specifically, they exempt. Like in case of a listed company, promoter can give their intent not to participate in the buyback in very beginning itself.
But other than promoters, if anybody can buy,
So
can participate.
Anybody can participate, not to participate. Both option is available.
No,
we cannot.
Manoj, what
we
RK
can-
is asking another question.
Yes.
One is I have there are 100 shareholder. Out of this, 60 is promoter, 40 is non-promoter, and I want to give only 20. That is allowed or not?
Yes, this is my
So
question.
offer need to be given to everyone. They may or may not subscribe to that offer.
But
SEBI.
that is okay. But what RK is asking, can I give offer to only 20 people,
No,
those
that is
who
not.
are there?
That is not possible.
No.
Unless you have a
SEBI,
written consent not to participate, they are not willing to participate, you cannot give selective buyback.
SEBI clearly restricts selective buyback. We have to give the offer to everybody.
Okay.
And
RK,
what about in the non-listed companies?
Unlisted company also, sir, if you have a specific letter of consent not to participate, then you may not give the offer to them. Otherwise, you have to give offer to everyone.
so you have to make a pre-plan for doing this. Okay, RK, you are doing you are I think one of the good investor also. I'm just asking as an investor, should investor trust EPS improvement post buyback?
Not clear to me.
No. Should investor trust EPS improvement like when you do buyback, then EPS will go up.
Yes.
Will you trust that EPS as an investor?
Prima facie, it may look that there is better EPS, but from the investor angle, it is not the single criteria for which the decision is taken, because you have to take the decision of investment based upon so many factors. So, I mean, this kind of enhancement in EPS due to reduction in share capital, that may not be a very objective criteria.
Okay. Now there are 22 questions, so I have to quickly do this. It is not beneficial for promoter to do the buyback when the market is bearish. Anjali, this is your question, which people are asking and discussing.
Sorry, sir, I missed it.
Is it
Sorry.
not beneficial for promoter to do buyback when the market is down?
Yes, it is. It is, sir. Where buyback is supposed to be a corporate action, especially for buyback, bearish and volatile markets only.
Okay.
But sir, it is not for the promoters. It is the
Not for
company's call. It is a governance issue that the company should take a thoughtful call that the money need to be put for business or to be distributed to the shareholder, not by the promoters. It should not be driven by the promoter in case of listed company.
Okay.
Agreed.
Under buyback, under market price adjustment, no adjustment in that case. Why market undervaluation of shares is one of the reason a corporate is considered to launch buyback.
I think he's talking about my slide wherein I was comparing between bonus and dividend and buyback. So what I meant was there is no change in case of a buyback pursuant on the market price. Undervaluation is a condition which is forcing me to come out with a buyback.
Okay.
Yeah.
RK, could you kindly advise on the taxation, the rate of surcharge of buyback for company and promoter shareholders in case of an unlisted company, both LTGC and STGC?
In fact, this is again an interesting amendment that when from the tax year 26-27, the regime has changed. Surcharge on the capital gains would be applicable as per your slab. or I mean, whatever the exemption otherwise is available for surcharge, keeping in view your total taxable income, that would be available. But the additional tax which would be applicable, and because they have said that if they want to take the rate up to 22% in the case of domestic company and up to 30% in the case of other than domestic company, then the differential amount is being paid as a additional tax under section 69. And on additional tax, there is a cap of 12% of surcharge. So on the normal capital gains, as per the slab or as per your normal provisions, whatever surcharge is applicable, that would be there. On the additional income tax, which would be to the promoters, then there is a cap of 12%. If it is less than 12, then that would be applicable as in the case of companies. But in the case of individuals, it may go up to 25%. But on additional tax, it will not be 25%. It will be a cap of 12%.
Okay, so many questions on taxation. RK bombardment is there. Tax applicability, private limited company, buyback of on shareholders. Timeline for private limited company once they communicate via email about buyback and have filed SH8 but waiting for MCA approval. Is MCA approval required for private limited company, Anjali?
There is no approval. No approval is required for buyback. Even SH8 form that we file does not require any approval.
Okay. RK, tax applicability, private limited company, buyback on shareholders?
No, it is taxable in the year in which company purchases the shares. So if there are any formalities prior to purchase, then till the purchase is done, means property in share is transferred, shares, the ownership is transferred, taxability will not attack. So taxability will be when company purchases the shares.
Okay. Alternatively, in a private held company, if the existing director retire or gift it to relative and then go it for buyback, what would be the taxation?
If some shares have been gifted by a person to his relative, which is covered within the definition of relative under section 6 of the Income Tax Act, then of course, when buyback is taking place, whosoever is the shareholder at that point of time, if that shareholder is not in the category of promoter, then promoter taxation will not be applicable.
Okay. Alternatively, who would be the best legal compliant way to play this buyback for closely held company? Your question is asking play, so we are not giving a reply to this. Okay. If you are asking clear question, we can give. Okay. For justifying the buyback price, is the valuation certificate required from a registered valuer, Manoj?
Valuation is required to be done for the purpose of board to take a decision, thoughtful decision. But just the price can be higher in any way, and that will give capital gain in the hands of the individual shareholders. So that is allowed.
Okay.
Sir, law doesn't mandate for a valuation certificate to be undertaken, valuation to be undertaken. It is the choice of the company from governance.
Like, yeah. Right. For income tax purposes, we have to understand, and for FEMA, if non-resident shareholders are there, then
so RK, effectively the buyback tax on promoter shareholder of unlisted company will be tax 22% plus surcharge 12% plus cess 4% is equal to 25.62%.
It is 22% plus surcharge 10% on 22% plus 4% on the tax. So the effective rate comes around 25%.
Around 25%.
In the case of corporate, and in the case of individual, the highest tax bracket goes up to 39%, including surcharge and cess. But since now on additional tax, surcharge is not 25%, it is 12%. So it will come down to around 37%.
37%, yes.
Okay. In case of private company or unlisted public company, can the company do a selective buyback? Let's say there are 20, same question which we have, RK was asking. So 20 shareholder and can be target to go for buyback for just for 4-5. We have given answer for this. Next, what is the TDS withholding tax impact on buyback of shares in 2026?
Yes. Yes, please complete the question. Please complete the question.
In case of listed company where there are FII, FPI and many domestic retail shareholders too.
in the new regime, there is no TDS or withholding tax to be deducted on buyback of shares. It was applicable on dividend. It is still applicable on dividend, TDS or withholding tax. But on buyback, there is no requirement of TDS.
Okay. Taxation for foreign shareholders.
Sir has already discussed. Additionally, we have to see their tax residency, DTAA benefits if applicable, and that based on that they have to decide what tax is applicable to them.
Okay, and what is the implication of FEMA?
FEMA, yes, FEMA. For the purpose of FEMA, if it is a proportionate buyback, I think it is 100% exempt. If you are participating in a buyback, and if otherwise valuation need to be done, and it will be considered to be a transfer from resident to non-resident to resident. So necessary compliance need to be done.
And the price will also be the registered valuer will do this?
Valuation, there is, though law requires charter accountant's valuation or a merchant banker's valuation, but now SEBI has restricted merchant banker to carry the valuation. So let's see, sunset period of 9 months is going on right now. Up to September, merchant banker can also give the valuation.
Okay. In the context of buyback of share under the provision of Companies Act and applicable rules, we understand that the company is required to open a separate bank account for the purpose of payment of buyback consideration. Anjali, we seek clarification for this, whether opening of a separate bank account is mandatory for all cases of buyback, including private limited company or small company, whether the account need to be designated as an escrow account or it to be opened as normal current account having debt authorization only for buyback consideration. Mani, can you share your experience that?
I think we should have a. I mean, there is no requirement to open a different buyback account as though. I mean, that's
Okay.
what I guess.
Okay.
Because this amount will get transferred to the escrow account, etc.
Okay.
Separately, but only for that purpose. I don't think you have to have another account.
Anjali, any view?
A special account will be open through which the payments would be made.
That is a separate.
Yeah.
That's the escrow account which I was saying.
That's yeah.
Okay. Anjali, you have given in a presentation MP adjustment in the bonus and versus dividend versus buyback slides. What it mean?
So when the company comes out with a bonus issue, say 1:1, and my running market price is 500 rupees, my market price will automatically get adjusted to 250 rupees. Likewise, in case of dividend, as per the dividend policy of the dividend declared, the market price would also get adjusted. But I'm repeating again, in case of a buyback, there is no such adjustment that takes place.
The why buyback by the company, that is the purpose. Excess cash can be used for expansion. Money and Vijay, why buyback?
Of a commercial call. It's more of a commercial call. I think each company or each board will be well equipped to decide how they have to utilize the cash, right?
Okay. Vijay?
Yeah.
Yeah.
As Mani pointed out, it's a call by the management. But what I would say is, if the company has not got any concrete plans to invest in technology or acquisition, I think they can use this opportunity to give the excess cash to the shareholders.
Okay.
So Pawan, I think one of the important thing what investors will ask is if you have an idle cash, see the return of investment has to be generated. Like for instance, any company, let's say if any company stock is at 1,000 rupees, right? They expect some return. If the same money is put into the FD, they get a return of about 7.5%. If the stock doesn't perform, if it doesn't cross 1,070 rupees or 1,000, whatever is that number, so then at least the expectation is that some yield has to be there. Now, if that yield is not moving, if it is not reflecting in your market capitalization or the movement in the price, that how do you allocate the best efficient way of doing this, not sitting idly on the cash? Because if that money is with the company, they will not be able to generate the extra money. If they have it with them, they may not be able to generate that cash because they don't have the meaningful way of deploying it. just in case.
Mani, the counter question to this, you're absolutely right. I have fund and I'm putting in FD. Every investor will ask what is return on investment. Okay. And that investment return is say 5%, 6%. Why you are not doing something? So that's why you are doing. But tell me why companies are not going for expansion and other thing if they have a continuous cash. If one time cash has come, that's a separate issue. But continuously are generating. Like Vijay has mentioned that they are generating continuously subscription.
Got it. So there should be a business case for anything, right? See, tomorrow I can do anything, whether I'm making a whether I'm taking a wild risk or calculated risk,
Okay.
right? So that defines. I can blow up the entire money today, which may not fetch. But if I'm taking a calculated risk, then I know the probability of returning money may be far higher. So it's not that the moment I have cash, I go and buy anything. It has to make sense for me. It has to, buying is not a easy thing. Buying a company has to culturally fit. It has to have a meaningful impact for your company. It has to, the synergies has to match, etc. If you see the study of all the M&As, 90% of the M&As or maybe 70% of the M&As are failures. So which is actually a value destruction than a value construction. So I think there are many things which you need to assess while from a management perspective.
Okay, perfect. Vijay, there's a one question. Why did Mr. Vijay's company do buyback so often?
No, as I told you, we were actually valued at 2,100 crores during IPO, and the current due to various reasons, the share price has gone down to 50%. So somehow people have to be the shareholders' wealth have to be maximized in some or other way. So we are doing buyback consistently for the last 3 years, at least to match with that expectations of the shareholders.
Okay.
That is the predominant reason.
Okay. Anjali, what is the difference between tender and open in buyback, and why was open offer not allowed earlier?
Pawan, sorry, with your permission, can I take leave? My other call has already started.
Yeah, okay, okay. Thank you, Mani. Thank you very much.
Thank you, everyone.
Thank you.
Thank you, sir.
Wish you all the very best. Thank you.
Thank you.
Thank you. So, Anjali, can you tell?
Yeah, I missed the question, sir, because money.
What is the difference between tender and open in buyback, and why was open offer not allowed earlier?
Open market, I think.
Open market. I think this question, please correct it. Please see Signet and Bharti Supreme Court decision doing selective reduction under Section 66. Manoj?
Reduction of capital is totally different provision, and selective reduction is allowed subject to approval of NCLT now. So earlier also we have done in many cases. So that is a totally regulated process. It is not the buyback. Buyback is done voluntarily by the company subject to approval of shareholder, subject to certain threshold.
Okay, our case question again, somebody is asking, can selectively buyback be done in case where the company is an unlisted company, has multiple class of shares, and offer is given only for one class? That is a different issue. So can I give one offer to one class?
Yes, that is allowed. Subject if
Preference
it is not
shares,
to others, we have to seek approval from them, but otherwise, yes.
So I can offer to the specific class of shares, but
Right.
I have to take approval from others. Am I right? Okay.
Right.
No change in market price when buyback happens, but undervaluation of shares can be reason. What do you mean by that?
I think
I think this answer
I've already explained.
Okay.
Otherwise, I can be called. I'll explain in detail.
You can call.
Yeah.
Anjali, separate bank account is required. You have mentioned already.
Yes, sir. We have explained.
Okay. As buyback normally happens at higher rate than the fair value price, would it be fit FEMA provision which restrict paying of the non-resident higher than the fair value?
No, yes. So in case non-resident, you are paying to non-resident, it has to be not more than the fair value as derived by the merchant banker or the chartered accountant with certain experience.
Okay, Anjali, the same question. What is the difference between tender and open market in buyback, and why was open market not allowed earlier?
So open market has been allowed since beginning. It was only with effect from 1st April 2025 that SEBI did away with this method because of various, again, the various understanding that promoters were more taking benefit of that method, and there were certain manipulative activities which were going on. So when we talk about the difference in the process, there is a lot of difference because tender is a fixed price buyback, whereas open market buyback is at the running market price. Daily, a different pricing is set for the buyback, number of shares to be bought back, and it is at the running market price.
Okay. RK, 2-3 questions very important. Is the case of unlisted public company whether the benefit of indexation is available to the shareholders in respect of shares tendered under the buyback?
Yes, because if indexation is allowed as per the normal provisions of the income tax, then the buyback proceeds are to be taxed as capital gains, then that indexation will be allowed. But now the indexation is no more there. Indexation only in certain specific situation indexation is there. Otherwise, there is no indexation. In long-term capital gain, there is 12.5% without indexation.
Okay. Okay. What would be the tax implication where a shareholder has acquired shares by way of gift and subsequently tenders such shares in buyback?
We have already dealt this question.
Yeah. Whether opening of a separate bank account, this is also be covered. Whether the account need to be designated, Anjali, whether
Yeah.
account need to be designated escrow account or it opened as normal.
It has to be. It has no. It is not. It cannot be a current account. It is a special account here.
Okay. Okay. What is the shift to capital gain taxation? How should the cost of acquisition be determined in complex scenarios such as ESOP, bonus share, and amalgamation? RK?
Because, we will have to look into the specific circumstances when the shares have been acquired and how the cost of acquisition has to be determined as per those facts and circumstances. But the basic provision of the buyback is that whatever the cost of acquisition as per the normal provisions of the Act, that will be allowed to be reduced, and only the tax would be applicable only on the capital gains. So sale proceeds of buyback minus cost of acquisition. Now the question is towards how to determine cost of acquisition in certain circumstances. So unless the complete facts are there, it cannot be decided right now.
Okay. Okay. How will the holding period classification, short-term versus long-term, impact the attractiveness of buyback by different class of shareholders?
It is difficult that how a company can determine that what is the holding period in the hands of different shareholders. To take a decision, it can be only when it is a closely held company, a private limited or a closely held limited company, and you are aware of all the shareholders. And there, if you plan that the holding period is more than 1 year and long-term capital gain shall be attracted, and you plan the buyback from that point of view, only then it can be happen. This planning aspect can be resorted in those kind of circumstances. Otherwise, in normal course, it is very difficult for the company and to plan the things in such a fashion is, it is more the theoretical question.
Okay. Okay. So I think we have covered all the questions and various questions as received through email. Before closing this session, I'm just posing 2 questions to everyone. Do you see buyback gradually being positioned as a secondary tool with dividend or capital reduction become more dominant under new tax regime? That is number 1. What further clarification amendment would you recommend to make buyback framework more predictable and litigation free and effective for investors? So I will start with Sandeep. Can you just give answer of any point of view by closing remark? Okay, Vijay, I will go to you. So what do you think? This will become secondary tool because our dividend will be more attractive than buyback? Or
No,
what are the changes?
buyback is actually an attractive than dividend. In fact, considering the new provisions of tax, so buyback will be a primary tool than dividend. That is my view.
Okay. And any suggestion you want to give, change which you require for changing buyback?
No, not really. If you have surplus cash and you're consistently growing, buyback is actually a better option than dividend. Absolutely, no doubt about it.
Okay. Sandeep, your view?
Yeah, I missed the question.
Whether the taxation aspects has changed the scenario, so buyback will be more non-attractive than the dividend and reduction of capital.
Yeah. Dividend will be more attractive rather
Okay.
than buyback.
And you want to suggest something for changes?
Changes, taxation should be changed. It should not be based upon whether it is promoter or non-promoter. It should be on a same line for both whether it is promoter, non-promoter, Indian or outside. The taxation should not based upon the category of the shareholder. Shareholder is a shareholder. Taxation should be the same for all.
Okay. Manoj?
Yeah. So I think it is very much clear that buyback is now post this amendment, Finance Act 2026. It is more attractive, beneficial in case market price is not sufficient and they are getting better price under buyback. Then obviously buyback is a better way to tender to take exit from a company. Even for unlisted companies, shareholders, it will get much more beneficial because of two things. One, it is not a dividend tax which is higher rate at higher rate. Other buyback, you are in case of capital gain, you can have the option of set off also. So in this case, it is always a better option. With respect to, I think, changes, they want to punish to the promoters, so that is one part. But the definition of promoter for unlisted company is very not very much correct. It need to be corrected. Those persons who have no control over the company should not be punished because they are not forcing the company to come out with a buyback in any way. So they should not get punished because of this additional levy. Sir, you are mute.
Anjali?
Sir, post the present tax amendment, definitely buybacks are more beneficial from the perspective of the shareholders as well. As regards the suggestions, I would want SEBI to relook into the introduction of the open market buyback. It would actually enhance the tool, the chances of more buybacks we can see.
Okay. RK, your point.
Yes, I said it earlier also, because the comparison of dividend and buyback, that which is beneficial from the taxation point of view and which should be done, I mean, as if these are substitute of each other. I don't agree to this view, because the objective of dividend is entirely different and objective of buyback should always be entirely different. If you are interchanging only from the tax point of view, that was the misuse due to which government has somersaulted and government has stepped into. And now, if we see purely from the tax rate point of view, the tax rate in the present regime is less than in the case of buyback is less than the tax rate on the dividend. Even for the promoters, surcharge difference is also there. I mean, that also makes a benefit of 2% approximately. But my point is, the objective of buyback should never be to distribute surplus cash. If it is, then distribute it as a dividend. If you want to do buyback, there are certain other larger objectives which are required to be achieved for the purpose of restructuring of the company, for the purpose of valuation, or for the purpose of the increasing or decreasing the shareholding of the promoters, or whatsoever. I mean, creation of the valuation in certain cases or exit to certain shareholders. These may be the different objectives. But to say that it is a substitute of dividend, this is entirely wrong.
Okay. And any suggestion?
I said that still the tax provision which are there from the point of view of the promoters, there is certain irrationalities involved in it. How we can plug the misuse and make it more rational, that we may debate and come out with certain simplified tax structure for the promoters as well.
Okay. So friends, now we have to close. We have already overshoot 10-15 minutes. Before closing this, RK, the presentation which you have given of the tax aspects, we have created a 2-3 simple slides, which we will send it to all participants also for their this taxation next. So this is one that buyback proceed taxpayers general income pool, tax rate, surcharge, and shareholders impact. Okay, until 2026 is new thing. And next slides. And this is where we have tried to simplify who is the shareholder, non-promoter, promoter, non-promoter, LTG 12 and 20, and promoter, domestic base 22, non-domestic base 30%. So the promoter penalty, all promoter, domestic and non
promoter domestic company है तो corporate आना चाहिए, domestic company.
Okay, we will correct it. Next. So this is one short chart we have created that I will share with all the participants. Now you have seen the buyback is not only taxation, but there are so many multiple things. So we have my team has created the complete buyback structure in a very one page, that is strategic rationale, surplus cash, return on capital, eligibility check, then who is eligible, what is the approval required, mode of buyback, SEBI backed regulation, then key compliance and disclosure, then execution process step by step, then taxation aspects, governance aspects, post buyback compliance, risk and key point, alternative to consider, key laws, important ROC filing, key stakeholders involvement, and final decision checklist. Is your buyback is best intent to company and shareholder, and then you proceed for buyback. So whenever you are planning to buyback, this checklist will be useful for you to understand in one go, that we will share with all of you. So friends, before closing this, as we are concluding this session, so it's very important that we are simply leaving one thought. Buyback is one of the most misunderstood concept and that tool in the corporate finance. Many believes it creates value, but reality is only redistribute value in one pocket to another. What truly matters is not the structure of the buyback, but it is the intent behind this. And the same buyback can build long-term trust or quietly signal a lack of growth. Without money, without things you want to do the buyback, or you have very few cash and then you want to do this just to play in the market. A lack of idea or even a shift in control. Sometimes people think. So we are moving now in the new era, tax-driven approach to strategy-driven approach, because taxation normally people were doing in place of dividend. The buyback was cheaper and not in the hands of shareholders. So everybody was thinking that let's company will pay and we will not. So this is another aspect. Now for companies, the question is not even we do a buyback, but should we do it? That's a very important question. For promoter, it is not about the increasing control, but about the demonstrating stewardship and responsibility. And for investor, real skill is not in reacting to buyback, but in reading the intent behind this. So real takeaway of today's our discussion is buyback does not tell you how strong a company is. It tells how the management think. And in the long run, market don't reward structure. Those who do buyback and they will get reward, because I have a data 70% companies are rate is going less. Even not today's market when they have closed the buyback. And in the long run, in my opinion, market don't reward structure. They reward intent, discipline, and trust, which is there. With these things, we are closing this session for today, and our knowledge sharing will continue. And the next program we are having on 10th, because already from first is holiday, Guru Purnima. Okay, so first is the Guru Purnima. So we are 8th May 2026. We are having a very interesting webinar on consultation paper on rationalization and MCA filing architecture under the Companies Act, because Companies Act is totally changing and new architecture is coming that we want to discuss on this. Till then, good night and thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.